Take a moment and look around you. Your savings, the social media you use, the news you watch, even the housing prices in your neighborhood. Behind all of these lies an enormous web of power, one that you may have never even heard of, yet is stronger than most governments. This is not a conspiracy theory. Today, the total value of assets controlled by BlackRock exceeds $10 trillion. Some sources even claim this figure has surpassed $12 trillion. This is the wealth that BlackRock has come to manage in just 36 years. To put it in perspective, that amount is more than 10 times the gross domestic product of the Republic of Turkey, which includes the city of Istanbul itself. BlackRock controls most of the banks in the United States, the majority of major pharmaceutical companies, a large portion of mainstream media, and about 10% of all publicly traded shares worldwide. It is now the largest institutional investor in technology giants such as Google, Facebook, and Amazon, the invisible power behind the world's richest people. Remember, whoever controls the money controls the world. And in history, no company has ever possessed global influence to the extent that BlackRock does today. The protagonist, or perhaps the anti-hero of this story, is a single man, Larry Fink. So, how did BlackRock, founded in 1988 as a simple investment firm, rise in such a short time to become a force that controls the world? To understand that, we must go back to its founder's ambition, born from great loss and a dark past. At the center of this story is a man who realized at a young age that true power lies not in politics, but in money. Larry Fink. Born in 1952 into a wealthy family in Los Angeles, Fink was known from childhood for his relentless pursuit of power.
Money talks.
In his youth, he studied political science, initially aiming for a career in politics, but soon shifted his focus to Wall Street. In 1976, he joined First Boston, a prestigious investment bank. There, he helped pioneer a financial product that would make Wall Street rich and nearly destroy it: mortgage-backed securities, MBS. These were complex financial instruments in which home loans were bundled together, sliced, and sold to investors. That process turned the American dream into cash, making MBS the perfect fixed-income product. Larry didn't just ride this wave, he created it. By the early 1980s, he had become one of the bank's top earners, generating over $1 billion in profits. At just 31, he joined the board of directors, becoming the youngest department head in First Boston's history. But with this extraordinary success came a growing ego. On Wall Street, the arrogant and ambitious Fink was remembered as an obnoxious man. Then came the moment of disaster. In 1986, believing interest rates would rise, Larry positioned the bank's risky assets accordingly. But instead of rising, rates fell. He thought his financial hedges would protect him from loss. But a single, devastating numerical error cost the bank $100 million. In an instant, Larry's reputation vanished. At age 34, he was fired. An ordinary person would have given up, but Larry turned this trauma into an obsession. The obsession with risk management. From that moment on, he swore he would never again be a victim of the market. He would be the one controlling risk. That obsession became the foundation on which BlackRock was built. This time, Larry Fink had no intention of losing. In 1988, together with Robert S. Capito, Susan Wagner, and 6 other co-founders, he established his first company. The firm was initially launched under the umbrella of Stephen Schwarzman's Blackstone Group, with a starting investment of $5 million. From the very beginning, BlackRock broke Wall Street's conventions by placing risk management at its core. Fink's key sales strategy was simple yet revolutionary. While managing clients' fixed-income assets such as bonds, he offered cutting-edge risk analysis as part of the deal. To bring this vision to life, Fink poured a massive amount of money into building a supercomputer capable of analyzing which investments could yield the highest returns with the lowest risk. That system became the brain and heart of BlackRock. Aladdin, Asset, Liability, Debt, and Derivative Investment Network. Aladdin was a technological platform that unified the entire investment management process through a shared data language. It allowed clients to view their entire portfolios, both public and private markets included. The platform could manage everything from portfolio construction to performance management, operations, and accounting. By 1994, BlackRock had grown rapidly, managing over $50 billion in assets. But that growth triggered a power struggle at the top. Larry Fink's desire for complete control over the company clashed with Schwartzman's unwillingness to share it. This boardroom battle lasted until 1994. When Schwartzman finally backed down, BlackRock gradually separated from Blackstone that same year. It was around this time that Aladdin proved its true strength to Wall Street during the Great Bond Market Massacre of 1994. As bond prices collapsed, BlackRock weathered the storm with minimal damage, thanks to Aladdin's risk models, which had been fine-tuned for 5 years. The event sent a clear message across Wall Street. When risk becomes complex, call BlackRock. After going public in 1999, BlackRock continued to grow rapidly. In 2006, the company doubled its portfolio size through a merger with Merrill Lynch Investment Managers. But the real turning point came with the 2008 global financial crisis. The main cause of the crisis was the same complex and risky products that Fink himself had pioneered back in the 1980s, mortgage-backed securities, known as MBS. When the crisis erupted, the U.S. financial system was on the verge of collapse. The U.S. Treasury Department and the Federal Reserve Bank of New York, the New York Fed, turned to Larry Fink for a solution. Why? Because through its Aladdin platform, BlackRock was one of the few companies capable of analyzing the risks of these complex, devalued assets. BlackRock's expertise was used in 3 critical areas, leading to the creation of the Maiden Lane LLCs. 1. Maiden Lane LLC, March 2008. BlackRock was tasked with valuing and managing roughly $30 billion in mortgage-based assets acquired from Bear Stearns in order to facilitate J.P. Morgan Chase's merger with Bear Stearns. 2. Maiden Lane 2 LLC, December 2008, created by the New York Fed to relieve AIG of capital and liquidity pressure. This vehicle relied on BlackRock to value about $20.5 billion in residential mortgage-backed securities taken from AIG's insurance subsidiaries. 3. Maiden Lane 3 LLC, November-December 2008. Also established to ease AIG's strain, this vehicle had BlackRock estimate the fair value of roughly $29.3 billion in complex collateralized debt obligations, or CDOs, purchased from AIG's counterparties. Larry Fink's team took on the task of valuing these toxic assets, performing risk analysis, and designing the bank rescue plans. As one former BlackRock executive noted, there were days when the Fed chair called Fink 21 times in a single day. In doing so, Larry Fink turned a financial catastrophe into the greatest triumph of his career. The operational authority he gained during this period gave him the influence of a head of state. At the height of the crisis, in December 2009, BlackRock turned turmoil into opportunity by acquiring Barclays Global Investors, or BGI, and its iShares exchange-traded funds, or ETFs, in a $13.5 billion deal. That single acquisition instantly made BlackRock the largest asset manager in the world. As BlackRock expanded rapidly throughout the 2000s, Aladdin also spread beyond financial markets. Aladdin, a technological infrastructure that unified risk analytics, portfolio management, trading, operations, compliance, and accounting into a single data language, was being licensed to global institutions, including banks, insurers, pension funds, and asset managers. By 2020, Aladdin was monitoring about $21 trillion for roughly 240 clients. That amounted to nearly 10% of all global financial assets. Aladdin had now become the operating system of global finance, just as Windows became the operating system for personal computers. Even BlackRock's major competitors, Vanguard and State Street, relied on Aladdin for risk management. BlackRock turned this technological and data power into political influence. 1. The revolving door. BlackRock effectively used the revolving door strategy in Washington. By 2020, according to members of Congress, more than 100 individuals had moved between BlackRock and U.S. government agencies, including the Treasury, the Federal Reserve, and the SEC. Former employees who entered public service could influence regulations in ways that potentially benefited their former employer, BlackRock. 2. Avoiding regulation. Through this influence, BlackRock managed to avoid being labeled as too big to fail. That label was central to the Dodd-Frank reform, designed for institutions that could endanger the financial system. Arguing that it was a money manager, not a balance sheet bank, BlackRock was exempted from these costly and restrictive regulations. 3. Shaping policy. BlackRock didn't just navigate the system, it helped shape it. For instance, there were claims of consulting and influence around the Canada Infrastructure Bank, CIB, where public funds were discussed as a means to encourage private investment and generate profit. BlackRock shares this power with another giant, Vanguard. Vanguard, which grew through John Bogle's low-cost index fund philosophy launched in 1976, has reached nearly $8 trillion in assets. Both Vanguard and BlackRock are major investors in media and technology corporations. This concentration of ownership creates a monopolization risk that could weaken genuine market competition. Larry Fink, in his annual letter to CEOs in 2018, called on companies to take an active role for the environment and society, announcing that ESG, environmental, social, and governance, would become BlackRock's core investment principle. He made this goal even more definitive in 2020. However, by 2022, this role had turned into a major crisis. Environmentalists declared BlackRock an climate monster because of its fossil fuel investments, while Republicans accused Fink of imposing ideology. In the face of this pressure, Fink initiated a quiet but profound retreat. In late 2023, BlackRock stepped back from its most ambitious ESG initiatives. While it supported nearly half of shareholder proposals in 2020, this rate fell to only 4% by 2024. Even Fink himself admitted in 2023 that he was ashamed to be part of the ESG conversation. When the ESG hype train ended, Larry Fink knew it was time for BlackRock's next strategic move. The new target? Infrastructure. Infrastructure meant the arteries of civilization, such as airports, pipelines, power grids, and data highways. Infrastructure investments offer stable and long-term returns because they create a monopoly. One of BlackRock's former executives called this strategy Larry Fink's $68 trillion game plan. The 2024 big acquisition. To implement this strategy, in January 2024, BlackRock acquired Global Infrastructure Partners, GIP, for $12.5 billion. This deal made BlackRock one of the largest infrastructure owners, directly controlling $150 billion of critical global assets. Control of global trade. In March 2025, a $23 billion deal was announced that envisaged bringing critical ports in the Panama Canal under American control. The The force behind this deal was not Washington, but Fink himself, considering that the Panama Canal is one of the most critical straits of global trade. This deal is a major turning point in BlackRock's move to seize the arteries of civilization. Larry Fink's infrastructure strategy became one of the most debated topics because of its potential to profit indirectly from global conflicts. 1. Ukraine Agreement. BlackRock, only months after the Russia-Ukraine war, with Larry Fink's personal agreement with Ukrainian President Volodymyr Zelensky, assumed a central role in Ukraine's post-war reconstruction. This is seen as one of the greatest reconstruction efforts since World War II. 2. Double profit allegation. Through index funds and ETFs, BlackRock is known to hold billions of dollars of shares in major defense companies. Critics accuse BlackRock of first financing weapons indirectly and then profiting from reconstruction investments, that is, profiting twice from killing. Although BlackRock rejects these claims, stating that they only track the market, its previously aggressive stance on ESG proves that, if it wished, it could influence the management of these companies. This shows the final stage of the system BlackRock has built, using public money and the outcomes of conflicts to provide high returns to investors without risk. BlackRock's goal is to make infrastructure investments the next major profitable asset class, as it did in ETFs. The ultimate risk of the structure Larry Fink created is that BlackRock now controls not only financial assets, but also the basic functioning of civilization. If a municipality sells its water infrastructure to a firm like BlackRock, the new owner, instead of fulfilling long-term maintenance promises, is only interested in profit maximization. As seen in examples such as water privatization in the United Kingdom, this can mean an increase in the price paid by the public and a decrease in service quality. Larry Fink's story shows that he set out with an obsession to control risk and created a structure even more powerful than countries. Today, as BlackRock manages the operating system of the global financial system with Aladdin and similar unregulated software, politics and society are shaped less by public votes and more by investment committees controlled by these giant companies. Experts such as John C. Coates of Harvard University ask, should a single company hold this much power? Even if BlackRock's power is shared with trillion-dollar partners like Vanguard, ultimately, this power, even though it is obtained with the money of anonymous investors, is concentrated in a non-democratic structure where decisions are made by a small number of senior executives. Larry Fink's rise shows us that money is not just a medium of exchange, but also becomes a weapon, an operating system, and ultimately, the invisible crown of the world.